Good evening, everyone. Welcome to another session of Option Surface webinar. How many of you attended the Option Surface webinar in the past? I would like to know, or is this something new for you? Okay, so let's begin the webinar. So I will just show you how to set up the Option Surface right from the beginning first, and then I will take you through the different features that we have in Option Surface. So you open the chart first. And in this chart, you need to use the symbol, spot symbol. Say, for example, if you're looking at Nifty, Bank Nifty, so you will have to use the spot symbol. So when you select the spot symbol, so any connection that you use, so whether you use a broker connection, data feed connection, you will have to use the spot symbols. And once you have the spot symbol, you right click, go to indicators, and search for option surface. You'll find option surface indicator. Now here again, you will have to also look at the same symbol out here as well, because this is the underlier symbol. So by default, if you're not switched to another chart, it will always come with the same symbol of your chart. So you don't have to change. But in case you see a mismatch between this symbol and the symbol inside the indicator, then you will have to go and change it here. So in this case, the symbol is same. So you don't have to do anything. You can select the expiry date, whichever expiry that you would like to track the data for. And then you have a number of days. So we recommend not beyond 5 or 10 days, because if you're looking at monthly contracts, then you could probably go for more than 5 days. But otherwise, you can only look at 5 days as default. Here you can select the interval as 5 minutes. You can select any interval you want. Okay. But we recommend for certain data points, we don't recommend going not even 5 minutes. You could probably look at 30 minutes. I'll come back to that when I show that data point. And then there are strikes that you can select. So number of strikes you want. So you can go for 16 or 32. That will give you a fair amount of idea what is happening in the entire option chain. So once you have this, you can select the parameter call change in open interest from the start of the session. Okay, so what does this mean? This is going to give you a visualization wherein you will be able to see the change in the open interest visualization from the start of the session. And if the data is not loading properly, so just right click and reload history server, and it will take up the correct data information. So now that I've put this for call change in open interest, what I will do is I will just make a side-by-side another panel, because I would like to see the view of call as well as put as well. Okay. So now when you see this, you get to see the view something like this. Okay. So what I'll do is I will duplicate this panel so that I need not repeat all the steps. I can duplicate this panel once and drag and keep it out here. And then I go to the settings of the option surface indicator. So if you click here, you will see the option surface settings. Here I go and change the data point. Rest of the things are all same. So I just go and change the data point and right click and reload the history server. So this will fetch the data fresh from the server. You can use this particular data point for only those data feeds where you get the historical open interest information and the tick level historical data as well. So, this you need to remember that not your regular broker connections may not give you this information. So you need to have either a data feed subscription or some of the data brokers who provide us tick level historical data. So now you can see both the views together, right? So this is the call change in the open interest for the call, and this is the change in the open interest for the puts. So you can see the date, the day break here. So this is the current day's movement. You can see the day break. You can see the day break here as well. So you know exactly what happened since the beginning of the session. Okay, now I'll keep one of the data point aside so that I can show you what exactly I'm going to show you with each data points, right? So When I keep my cursor, just look at the cursor and also the data points, data values here at this section. Okay. This section. So what happens when I keep my cursor, you will be able to see as I keep my cursor, you can see the values. So if I've kept the cursor right now at this level, which gives us an indication that I'm looking at the strike price of 45,000 call option. The option open interest is 2,69,065 and the change is 1,27,828. So if I keep my cursor slightly above, you will see the data point, same data points, but for the strike 45,100. So this is how you can look at the visualization of it. So let me zoom this for now. And this is, let us analyze the data, what happened today in the call option. When the market started, it started with the gap up opening, and we saw call writing happening at this level. Why I'm saying this level? Highest call writing that is happening will be visualized in a brightest blue color. So if there is a highest unwinding, it will be in the brightest red color. So if there is a negative option writing is happening, I mean option short covering is happening, in that case your color will become darker blue and eventually it will become darker red and then a brighter red. So if the brighter red means most of the covering is happening at these levels. So if you look at this, so whoever has been selling these strikes so at these levels, I have started covering around these levels, all these strikes. Probably because they would be losing money because market has started going much above their premiums. So they have started covering the positions. So let's look at what has happened with the at the money strike itself. So I'm not going to go into out of the money strikes. Let's focus right now only with the at the money strikes and what people are doing at that particular time. When the market started, they started selling around this 44,700 strike. Why? Because most of the morning session, you will see straddle selling that is happening. If you keep the put option as well, so you will also see a same around the same time. You will see the highest put writing is also happening at the same levels. We will come back to the put option little later. So let me give you an idea about it, and then we will evaluate what is happening with the call as well as put, and then the correlation between the two. So if you look at this, when it started, the open interest was at this level was only 74,160. It gradually increased, okay, because market was all along was below this level. So obviously people will start selling the calls because they are very confident that the market is not going to go up. But when the market started moving higher, you will see that all of a sudden you see that the short covering has started. So this sudden movement from 2,33,000, I think that was the peak. If you just observe the values here, okay. If you see here around 2,33,000, that is around 1055, the highest open interest on 44,000 call option was at 2,33,650. And soon after, market started recovering and made a big move out here. And you saw suddenly a short covering is happening. Now, what happens when the short covering happens? People will start expecting a possible upside move. And you will see if they are very convinced that the market is not going to go up much, so they may start writing only one strike above. Okay. However, you can see that they started writing almost 3 strike above. You can see this open interest started increasing out here, and they started writing 3 strikes above, which is an indication that the market is probably finding a bottom and started showing recovery. Okay. Once this level is around this level, market was not doing much. Again, people started selling higher levels because market started moving above this level as well. So they started selling higher. Thereafter, once the market corrected below this again and corrected this, after this candle, you saw a steady open interest, I mean the call writing happening at a single strike of 45,000. Okay. And this went on increasing as and when the market was going, and it peaked at some stage around this level mark, it peaked. So you get an idea that once the market open interest starts peaking at some stage, okay, that could act as a possible support for the market at the lower levels. So even if you're looking at this information on top here, if the market starts continuously increasing the open interest, or you start seeing this open interest moving lower, that means that market is still expecting a further downside. But if the market is not, it has reached a certain open interest and then started showing some weakness, this indicates that, like, you can see from here, it peaked around 2 o'clock, 2:10. And after that, you started seeing some kind of a correction in the open interest value. So open interest started decreasing for this particular strike. So even if you don't look at the other strikes, you get an idea where people are writing the highest open interest, and that is something becomes a possible trending information for you to know. And once the market reaches that level, so you can see that market is showing signs of some kind of a strength. So even if you're not looking at any technical indicators, so you can get an understanding that, okay, if I have to take a trade on the opposite direction, probably this is the time for me to take a trade with some kind of a stop loss, probably the stop loss at the lowest level for the day, or maybe few candles below those levels. So if the market is consolidating in this area, you could probably looking up a stop loss around this level or maybe around this level. So this is how you can analyze this data, even if you are taking a one-sided option buying or something like that. So once this happened, so you could see gradual decrease in the open interest. Any questions so far?
At this point, the next candle has already moved up on the next strike, higher strike.
Correct.
But the color, the red color will come only at this time.
Which red color are you talking about?
The unwinding.
This one.
Correct.
Yeah, see, this is going negative from this thing. So you see the net change values here. They were all positive until here, till it became red. Negative means that there is a huge short covering happening at those strikes, because they are losing money at that level. If they hold on to that position, they will start losing money. See, when the market breaks, right, to some extent, people wait for 1 or 2, probably 10-15 minutes, because they still have that advantage of that extra premium that they got in. Probably they have been carrying over the positions overnight or since morning up to this level. They know that, okay, if what was the premium at that time? You'll have to look at what was the premium at that time, right? So that you have to look at, and if the premium is enough for them to cover up any potential move upside, they will hold on to that for some time. I will show you that with the put visualization, so you will get a better idea about how to correlate this information together. So because for the sake of information and understanding, I'm explaining only one of the data point right now with the call only. So this is where you saw you saw this movement. After this, you saw a sudden increase in the open interest at this level. You saw unwinding happening, and you saw open interest increasing at this level. And even when the market touched this level, they started increasing the open interest at this level. So I don't know how many of you are option buyers and how many of you are option sellers, but if you're an option seller, what you will do, you will start adjusting your positions according to the market, what is showing you. You're not going to sit at that level holding on to these positions, right? So you will always try to be away from the market so that it doesn't affect your risk as much as possible. And what happens is you want to be in the market, but you also want to play safe also. So if it was clear that once this level was broken, probably market was breaking the possible upside, right? Like, you can see that there was some kind of a consolidation happened at that yesterday, and market is now showing some strength out here. So suddenly you saw a increase in the open interest 3 strikes away. That gives you an indication that, okay, so something is happening here, right? So market is going to show some strength around this level. So you as a seller, you start looking at what is happening with this information, where the call writers are selling, so you can be with those people, so that and adjust your positions accordingly. As an option buyer, what you will look at when these things are going to change. So if the market is moving higher, and somewhere it will start showing some weakness, right? It is not, if the market is continuously going up, obviously you will see that the strikes are being written at a higher levels. But what, as an option buyer, what you look at, you will start looking at where exactly the open interest is peaking. So you know that this is where the highest open interest is getting written now at this level, and you will start seeing where exactly it is peaking. So what happened here? It moved up to 1,45,000 here, around this level. Thereafter, you started seeing a sudden big correction. Okay, so if you are not able to differentiate the candle, you can go and change the candle color. So the market started peaking around this level. The open interest is peaking around this level. So this is an important data point for us to look at. And once this started peaking at this level, you can safely assume that market may see some kind of a correction. As an option buyer, I will start looking at this information. As an option seller, I would like to be with the market where highest open interest is being written. So now what happened after that? You saw sudden decrease in the open interest because probably in this 10 minutes time, you would have had 2 or 3 data points. But even if you see such a big correction, like, so this is a big movement, right? 145 to suddenly 131, almost 14,000 or 13,000 plus lots of open interest being reduced all of a sudden. So this will give you an indication that the market could be peaking around this level, and you can start taking a possible put option bet, or you can start selling the futures, or whatever you like it. So let's go back again to these levels now. Again, now you see that open interest being written at this level. People have started writing open interest at these levels as well. But the highest open interest is still at this level, which indicates that the market is still hoping or expecting the market to recover. If the market starts showing weakness, right, a sudden weakness, and the market is expecting, these option writers are expecting that the market is going to sharply fall, or it will not going to recover at all, you will see a steady this light blue area going down and down on a continuous basis. However, in this case, this is not happening. It doesn't matter to us much, but what we are looking at seeing here is, suppose now we are trying to look at where the market could see a recovery. Okay, so what you will start looking at, you will start looking at these values. Now these values are gradually should be going up. If the market is going to go down, these values should be going up. Now what happened here? So around this level, again the market peaked around 2,73,117 open interest, and next data point we started seeing some kind of a reduction in the open interest. It peaked, it suddenly reduced from 2,73,000 to 2,64,000. This is an indication that the market is probably has made a possible low at this level. Now, is this a good time to buy? It is entirely up to you, because if you have to take this trade, probably you'll have to take a 170 point risk on this. Okay, even if you're taking at the money trade, you will be taking a much bigger risk out here. Yeah, reduction could also mean rolling down possible, but rolling down does not reflect so much at the lower levels. You also need to look at what is happening with the rolling down as well, right? So if the market is moving, okay, you need to see at a lower level what is happening as well. If I'm option buyer, I am looking at where exactly market is going to pause, right? So market is going to pause somewhere. If the market is going to go down continuously, will happen is that a steady increase in the open interest across the board. So you will not see a reduction in the open interest only in certain strikes. It will happen across the board. Okay, anything above the current price strike. Okay, any strikes above the current price, it will start seeing some kind of an increase in open interest. Now, what happened here is you slowly started seeing some kind of a reduction, but again it started increasing also. Then around this level, you saw market started showing increasing open interest again. So that means the market is still not sure what is going to happen. But at this level, you can see from there very, very clear that the reduction is started and market also started showing the increase. This is what you are looking at. What you're looking at is where exactly I can put my stop loss and take an entry. And probably if you are taken an entry at this level, you will have a bigger risk. If you are taken an entry around this level, even if you want to take a chance, you would have probably as a very nominal risk out here, right? So even if you think, okay, suddenly market is started going down, and next candle started showing a recovery and it closed higher. Okay, so now you know that your risk is much lower as compared to the previous one. So now let's look at what is happening with the put as well at the same time. Okay, so let's analyze what happened in the put side. So again, morning time when the market opened, a lot of put writing also happened. At the same time, the call writing is also happening. That's quite common these days because people go with the straddle selling. So you will always see highest open interest is written at the money calls and puts in the morning. This goes on till probably 9:30, 9:45. Sometimes it can go up to even 10 o'clock. But most of the time you'll see that option writers who do straddle selling will start selling at these levels. Then again, you saw suddenly the open interest being written at the lower levels. Now here you have to start again looking at what is going to happen with the open interest. Is it going to be increasing, decreasing? That is what you need to look at. Now you know that one data point is very, very clear that so how you can identify the possible reversals. So based on the change in the open interest, you will start looking at the possible reversals. Now here you can see that since once this open interest started writing around these levels, you will see that there is a gradual increase in the open interest, and probably here you saw some kind of a open interest reduction here. Okay, so you can see what has happened at the strikes as well. But then once the market reached this level, you saw an open interest increase here, and then people started selling open interest at this level also. Now this is something interesting why people are selling at these levels. Okay, because market is already recovered quite a lot. Even if they were writing, they would be writing around these levels, but you saw a sudden increase in the open interest at this level. And this could have been a trap around this level because people started thinking that the market is going to go up further, and thereafter that's why they started writing at this level. And this could be because of this reason as well, because you saw a sudden increase in the open interest writing at the higher strike. And that's where probably people thought that, okay, market may be going up further upside. And that's where they started writing around these levels. Now, once this level broken, you'll see that suddenly a decrease in the open interest. And market also showed a weakness. So now let's look at other data points that we have. I covered the data points related to change in the open interest from the start of the session. Now I'll start. This is something, again, we have this data point where I put this information on a 30-minute interval. Okay, not on a 5-minute interval. So this data point is change in the open interest interval by interval. So if you put at a very small interval, you will see lots of boxes. This will not give you much indication. But if you want to see where exactly a sudden decrease or sudden increase is happening, so you will be able to identify. But again, I would say look at this data point with a minimum data period of at least 30-minute interval. So if you go to the settings here, I have selected interval as 30 minutes. Okay, so this is not such a big data point, but in case you want to see a big increase or big reduction in the open interest, if you want to identify, you can use this point. Next is the data point, which is related to open interest buildup. So now this also looks at the price as well as the open interest changes as well, right? So now when you see here, you will always see a inverse direction in these colors, right? So the red color indicates a short buildup, green indicates long buildup, blue indicates short covering, and yellow or the orange indicates a long liquidation. Red is for short buildup, green is for long buildup, blue is for short covering, and orange or yellow is for long liquidation. So now you will always see here where exactly this is happening. So most of the time you will come to know this is happening again across multiple strike prices. So now what indication you get from here is another clue for you. If you have started looking at the data point, another clue for you. From here onwards, market started showing long build-up in the calls. At the same time, you see a short build-up in the puts, which is an indication that the market is showing a strength. So again, the visualization is the same. As you move your cursor, you will see the different strike prices. So that visualization remains the same. So if you look at this information here, so this is where you could get an understanding that the market is showing a possible recovery from this level because people have started building longs in the call option and shorts in the put option. And once this level was broken, you saw a sudden short covering also. There were probably a lot of people who are on the sidelines will start looking at this. Okay, now the market has started increasing and it can increase very quickly. So you will see that there is sudden increase in the short covering as well. Long buildup has already started earlier. Now you see starts with this short covering as well. So here also you see continuously short buildup is happening at most of the strike prices closer to these prices. So same way, once the price has reached this level, you saw a short buildup is happening and short covering is also happening, which is an indication that puts are being covered and short buildup is happening in the calls. So this also gives you an indication about what is happening based on the data point, which is based on the open interest buildup. Here you can see across all strikes on a single screen. That is an advantage that you have with this information. Next is the put call ratio. So I have both call and put, Nifty and Bank Nifty put call ratio out here. So what I'm interested in this data point is where exactly the light blue areas are. These light blue areas, and to some extent, these light pink areas are, okay, or light red, you could call it. So these are the data points that I'm interested in. If the market is far below these levels, that means the market is slowly has a long way to go to recover to these levels. And these levels act as a very, very strong support and resistance. So now what happened? If you see previous data points, let's look at, I think this was the highest light blue area. Okay, at some stage market closed here, and you can, let me, okay, so any fall below, a close below this light blue area gives us an indication that the market could, this light blue area's high level can act as a strong resistance for the market. Okay. So here, whatever the strike price is, 45,600, can act as a strong resistance. In this case, market closed lower here. Okay. And once for this, market has to go into this zone first and then close below. Okay. So that is important. Market has to go into this zone. And if it goes into those zones fully, here you see this, it went into the zone, but not fully. None of the candles were closed inside this zone. So for tech, if you have to look at it, I would preferably want these data values to be inside the zone, some of the candles to be inside the zone, or at least at least one or two candles to be inside this zone to take a decision. So now what happens? Market remained in this zone, acting this level, acting as a strong resistance, and then market closed lower. So this is where I would start looking at market could be possibly showing a weakness. So if I have to take a trade, I would put a stop loss at this level and take a trade. Okay. However, in this case, the market failed that, and thereafter market remained in this territory for a longest period of time. So once the market is in red, then you can assume that, okay, this peak is definitely in place. Once the market is completely in the red area, so you can consider the market has already peaked out from these levels. So now you get an opportunity here. So you will see that the market is always remaining below these blue areas, so acting as a very strong resistance. So here you could see one of the candle inside this blue area, and then market closed lower. So this is an indication that the possible this level, or this level itself, the high itself, or the light blue areas, the high area, can act as a strong resistance, red area. But if this was in the blue area and the market had closed after that lower, then I would take a trade here as well. Okay. Now, but here you'll see the market is already in the red zone. So you can consider this level can act as a strong resistance. So market is showing continuous weakness, and market closed above this level around this year, right? Here market closed. So this was the lowest light blue area. So you could consider at this stage, you could consider the market is possibly showing strength, and you could consider this level can act as a strong support. And again, in the next bar also, market closed above the another blue area. So as the market goes above this blue area, you will understand that the market is showing strength. Now, what happened here? So market was above the blue area. If I would have taken this trade, because the moment market closed here, I know that this could be possible resistance for me, and I would have taken a trade. But market again now went into the, it would have hit a stop loss, and market went into the upside. Again, you get another opportunity here. You will see the market has gone into the light blue area and then started closing below. So now this you can consider as a possible resistance for the market and start building your short position. And here market was, this is the lowest area, so market is closing, but it is not breaking with the blue area. So I would wait for some kind of a confirmation before I could take a trade. Now, if the market goes below this level anywhere, because now the market is went into this zone, and if it continues on Monday in this light blue area, and the market starts moving lower, you will start taking a short position. So you know how to exactly build this particular information on your chart. Whether you need to look at all the data points, it's entirely up to you. I would say you could avoid this data point unless you are looking at some kind of a sudden increase or decrease in the change in the open interest interval by interval. So you can look at these three data points, this one, open interest buildup, and the put call ratio visualization. So this year you don't need to do it for call and put separately. That's why I put one for Bank Nifty and Nifty as well. Okay. So I will share the template. Maybe I'll remove this data point and share the template. So you can start using this template. thank you so much for attending this webinar, and have a good weekend. So we will be putting out our new webinar schedule next week. We are planning a webinar on market profile in Hindi. So 2 series market profile. It will be actually going to be a 4 series market profile webinar in Hindi. So it will be divided into 2 weeks. So we will let you know the schedule for that, and we will update you on latest by Monday morning. Thanks a lot. Have a good weekend.